Hello and welcome to Core London. I'm Matt Brown and I'm joined today by Ben Kumar from 7 Investment Management. How are you today, Ben?
Very well, you?
Very well, very well. Thanks very much for coming on. Now, lots going on in the markets. We're into September. Now, September and October can usually be a bit of a turbulent time in the markets, but we've got lots of moving parts going on. Dollar's weak, gold's up, Draghi yesterday. What's your take on the global markets and certainly the geopolitical situation we've got going on as well?
Okay, so the thing that everyone is kind of waiting for is for the European equity market to get going. Right? Everyone, pretty much since the start of the year, has said, look, Europe's going to grow this year. It's going to be spectacular. And you know what? Draghi revising up his growth estimates to the fastest we've seen since 2007. Things are going well in the Eurozone. German consumer, however you want to paint it, it's looking good. And the markets just haven't responded. We saw earlier in the year a bit of a bump on the back of Macron. We saw some good earnings come through, 15% earnings growth in the third quarter. You know, that is spectacular stuff, really. Yet, the market just isn't doing anything. And people are, it's quite an odd situation where for so long we were worried that the euro was weak because the Eurozone was going to break up. Now the euro's strong, everyone's saying, oh, it's going to damage profitability. You know, I think that's the puzzle we're waiting to unwrap. You know, how can European companies keep making profits when the euro's strong? I think they can, but the market's not convinced.
And we're seeing that happening with certainly the DAX and with a lot of exporters in the constituents of the DAX. So it's really weighing on that. So from your point of view, there's value, would you say, in European markets at the moment?
I think there is. You just have to get over this hurdle of, it used to be that the European equity market fell when the euro fell on the back of, you know, weakness and are they going to break up, is Greece going to default, whatever. Now the European equity market falls when the euro's strong. They're gonna, you know, they don't get a win here.
You can't have it both ways.
Exactly right. So I think there is a lot of value in Europe. I think the small and mid-cap sectors, which have done better already, look really, really attractive. If the German consumer is finally borrowing, finally levering up after 20 years, that's something you want to be part of.
Super. And would you include the UK in that and the FTSE in Europe as a whole? Do you think the FTSE's due an uplift as well?
So the kind of hidden message about the UK is that Brexit's going on, that's fine, and we all see these headlines. But for now, our largest trading partner, which is Europe, we haven't, you know, gotten out of any treaties, is growing at the fastest pace we've seen this, you know, in a decade. That is good for the UK. That is unequivocally good for the UK. There is uncertainty about the future, but right now, things are going really well. The UK, you know, the economy will benefit.
Fantastic. And we've seen a rise in gold, and we can put that probably down to North Korea fears. Do you see North Korea being a headwind for equity markets?
If you look at Korean consumer confidence, I'm talking about South Korea here, it hasn't really moved. It's been on an upward trajectory since the start of the year. So part of me thinks this is normal, right? Now we happen to be paying attention to it, right? Because we know that we're all very fickle in the markets and suddenly something is really, really important and we can't see past it. You know, when was the last time you talked about the Greek debt situation? It's still bad, by the way. We've just stopped being interested. So North Korea, the tensions that are ramping up, I think they're probably exaggerated in the amount of airtime they're getting given. That being said, there is clearly a change at work here, and I don't think it's on the North Korean side, right? I think it's on the American side. The fact that, you know, the market probably ignores North Korea. You know, it fired an ICBM over Japan in 2015. You know, that kind of thing is sort of par for the rocky road that North Korea is traveling down. The problem is that the US now seems to be a little bit jumpier, and no one's quite sure of what the policy approach is. Again, that being said, the US policy machine, not talking Donald Trump, talking the US policy machine, is slow, it's practiced, it knows how to deal with these kind of situations. You know, I believe that the North Korean situation is unlikely to kind of get much worse than it is now, but I'm pretty confident the market won't think that for a while. Gold, as you say, and other safe havens, silver, Bitcoin as well, right? You know, all of these things that are not related to, you know, good times are doing well.
And you mentioned Trump and the US. are you still looking at value in the US? Is there opportunities there, or are the PE ratios too high? What's your take on the US market at the moment?
I think the US market, when you look at it as a whole, looks really expensive. When you start digging down into what's making it expensive, guess what? It's the tech stocks, right? Now, the question everyone's asking is, can the tech rally continue? And lots of people will say, no, these valuations have gone too far. There's no way they can sustain these. Where are the earnings going to come from? But at the same time, you're reading so many pieces from people about, this is the new wave. This is the industrial revolution. This is like saying that, railways won't keep their value. Back in the 1800s, it made people billionaires, right? For the first time in history. Tech stocks, I think, have the potential, if they're embraced fully by the economy, they can go a long, long way further. So every time someone tells you the US is expensive, take it with a pinch of salt. Everyone said Amazon was expensive 1 year ago, 2 years ago, 3 years ago, 4 years ago. It's kind of quintupled since then.
Incredible. And with regards to a portfolio at the moment, would you be looking at being overweight equities, underweight bonds, overweight cash? What kind of makeup are you looking at the moment?
I think a slight underweight to equity is kind of acceptable. It's been a reasonably good year, and for a diversified portfolio, you don't have to chase the market up and up and up. You can be in areas where you think there's more value. Frontier markets is one that we always talk about. They tend not to behave like the rest of the world, but you've got some really cheap companies. At the same time, and everyone says it every year, bonds are dead, this is the end of the bubble. Guess what? Bonds have done really well this year. People who've left them out of a diversified portfolio have suffered. Fixed income is still a good portfolio tool to use. So, yeah, be underweight, but don't have zero bonds in your allocation. US Treasuries will, time and time again, keep performing.
Well, on that note, wise words. Ben Kumar of 7 Investment Management, thank you very much for joining us today.
Thanks.